Welcome to the Monocle Banking Podcast, curated as always by Monocle Solutions. Today we're talking about one of the most important and least understood parts of South Africa's growth story, how ideas become companies. Not ideas in the loose kind of conference speak sense. I mean the much harder business of taking intellectual property, research capability, engineering insight and scientific discovery out of universities and into the market, where it has to find customers and raise capital, hire people, compete globally, and ultimately survive and scale. And it's a really interesting question that was thrown into sharp relief recently, where Stocks Strauss has announced the final close of its University Technology Fund 2 at 400 million rand. It takes the total capital across its university-linked early-stage investment platform to more than 700 million rand. And it now spans UTF-1, which is fully deployed at 230 million rand, and the UTF Seed Fund at 86 million rand, and now UTF-2 at 400 million rand. Also a very interesting investor base that is very telling as well. Well, it's a great pleasure to be joined by Wayne Stocks, who's managing partner at Stocks Strauss. Wayne, welcome to the Monocle Banking Podcast. And just before we talk about IP, I mean, you're a CA, you currently serve as a director at Smile Identity, which solves user ID across Android for companies scaling volume or higher value transactions in low trust environments. You've previously held various senior and executive finance and commercial positions in South Africa and the US and Dubai and the UK with companies from the likes of BHP Billiton in London and Houston, and as the FD of one of the Middle East master developers based in Dubai, managing property development in a portfolio of circa $5 billion US. You've also worked independently with Sun International on prospective development, so a broad range of experience. Firstly, tell me how you came to form Stocks Strauss with your partner Daniel Strauss, who seems to be probably more heavily steeped in the private equity side.
Yeah, well, what a privilege to be joining you today. I think it's amazing to shed more light on this underserved asset class. I guess the journey started for myself and Daniel in about 2012. I was tired of corporate and started my own thing, and essentially was part of a couple of startups. Daniel also was part of a private equity shop and was a bit disillusioned with how private equity was traditionally being done in South Africa, which was taking a big slice of the pie and really squeezing the entrepreneurs. And we had that kind of meeting of minds and a shared investment philosophy and shared values for that matter. And he walked into my office in 2012 and said to me, Wayne, we've had conversations for 2 years. We're doing a lot of similar stuff. Why don't we just put everything together and do this journey together? And like any founder, you need co-founders to pull you along those ups and downs. It's never easy to be an entrepreneur. And I think I found that in Daniel. We're very different. We come from different places and different backgrounds, yet those shared values really carry us forward.
Yeah, and I think sometimes people misunderstand or underestimate just how entrepreneurial being a private equity GP is. Very similar to a business. High risk, high reward, absolutely. But, you've got to go out, you've got to raise capital, you've got to find deals, you've got to deploy that capital, often sitting on the boards of the investee companies. You've got your own skin in the game. You're aligned with the founders of these companies. You've got to look for exits at the end of the day. And all of these processes, many often run concurrently. Yes, private equity gets a lot of the spotlight when you do big deals, but it can be a lonely journey. So it's important to find someone who's got that value set that you can do business with, isn't it, Wayne?
Completely. You need to be able to trust each other. Have cognitive biases when we're looking at a potential investment opportunity. And you need someone who can have those frank conversations with you to say, hold on, I'm from a slightly different angle. Are you too close to the deal? Or just, we have bad days. It's a very high energy, sometimes very sapping environment because as an investor, and I think, you have to get in and it's about the people, it's about the teams. And sometimes, you go down a rabbit hole and you need someone to kind of pull you out of that. So I found that in Daniel, and we certainly hold each other to account. We see things differently. And having someone to bounce things off all the time in a very honest and open way is exactly what one needs.
Now, let's talk about the big picture in South Africa and why university tech and why now. South Africa is certainly not short of kind of policy language around innovation. It's almost in every strategy document. But we are short of scalable tech-led companies. Why is it that university-linked commercialization is such an important place to intervene if we want to turn that around?
Universities generate breakthrough research, patents, and those high-skilled kind of talent, right? Which is the raw material for deep tech and disruptive startups. You can come up with a really good idea in your own backyard and develop that. But if you want a technology that really solves really difficult problems, universities are brilliant for that because you have a lot of cross collaboration between different faculties. Whereas potentially in a corporate, you're slightly one dimensional functioning in one particular sector. Universities, you can have 3 or 4, 5 faculties working together to solve something completely unique. So that's why we've focused on that. And there's a global pattern. If you look at the leading innovation hubs in the world, they're all anchored around top universities. And just finding high skilled raw talent when you start a startup. I mean, what better place to look at universities? And then one of the other key stakeholders, of course, is risk capital. So, it's a VC magnet. The proximity of cutting edge research attracts venture capital and creates clusters for high growth companies.
And it's interesting, we have seen some really successful carve-outs of IP from universities enter into the private equity ecosystem. I think here of Tessara, which was really IP out of the University of Stellenbosch to ensure that we could prolong the life of table grapes using a very interesting laminate SO2 technology. And they won the Catalyst Private Equity Deal of the Year. Oh, I'm giving my age away here, probably over 10 years ago now. But it was a great example of IP developed inside a leading university, especially when it comes to agri-innovation, and then scaling that with the right private equity capital and also access to networks. But it does seem to be a bit of an outlier, Wayne. I mean, we've got very good universities by emerging market standards. Why have we not seen more university-originated companies scaling internationally out of South Africa over the last 2 decades?
That's a great question. I think that's something that we found 7 years ago, and I think it's something that's improving. If you look at MIT, and I was fortunate enough to do an MIT fellowship over the last 8 months, MIT have identified 5 key stakeholders in any successful innovation ecosystem. And when they don't all align and work together, it's very difficult to actually have a spin outside scale. So some of the big issues we've potentially identified or challenges we've identified is it's not a failure in the quality of the research often. It's a failure in the translation from the lab to the market. Often there's a mismatch between novelty and need, right? So research essentially is done to optimize for publication, where venture optimizes for solving a real problem or need that users are willing to pay for in an effective and scalable manner. Another big challenge we have is the lack of true founders. So great IP without commercially driven operators doesn't scale. So you have highly technical founders, but you don't have experience how to commercialize, how to build products, how to sell, how to speak to people, how to build teams. And then one of the things we really have found is just an incentive misalignment. So sometimes universities create poor spin-out structures where they don't incentivize the right behavior for founders and investors.
Yeah.
There's sometimes also a speed mismatch. Academia moves pretty slowly and startups need rapid execution and iteration rather than continual research.
When a university originated technology becomes investable, if we want to get into kind of the plumbing of it a little bit, who should ideally own what? The university, the academic inventor, the founder, the fund. Sometimes you've even got, the state involved if it's funded some of the research.
Yeah.
How do you tend to see the mechanics of that play out?
So that there lies the crux. I think if you look at the developed ecosystem, specifically in the US, the universities tend to take a very small equity position. And that leaves ample equity available to the operating founders rather than the founders that are sitting within academia are not actually going to be operators in that company helping it be successful. So, and then they often have a large kind of ESOP, which they can then put forward to hire key staff, and then the investors come on board. So I think these things tend to take longer. So, deep tech and things that come out of universities tend to take longer, which means you need to have equity available to incentivize the founders and operators, and more equity available for investors. And I think that's where in South
Mm,
Africa we have a challenge. Universities are not aligned on this. Universities tend to take too much equity up front, as well as then the professors are often who stay at the university take a large piece of equity. So when you now are looking to people to actually run this thing, they
yeah,
have a very small equity incentive. And 5 years down the line, people get disillusioned because, hold on, why am I doing this? And I only own 5% of the potential upside
yeah.
when I can be earning a huge salary at a corporate.
Yeah. So how do you prevent that classic problem of dead equity on the cap table where the institution owns a large stake but is contributing
Yeah.
little operationally after formation?
So what we've done, and we've done this in collaboration with, of course, with the universities that we invest in. But what happens is we come in and we say, listen, can we actually clean up some of that cap table? So we, as the University Technology Fund, understand the complexity. We've walked this road, and we do see ourselves as partners with the universities, because at the end of the day, the deal flow comes through them. So what we tend to do is we add some growth capital to that capital that stays in the business to help scale, and then we do some secondaries where we can potentially buy equity, or what we often do is we invest in the company, and the company uses some of that cash to buy back those shares, and then it can hold those to further incentivize founders or next hires.
Mm.
So we've done that on multiple occasions quite successfully. But what we're now doing is we're really getting right up front and center before the spinouts are actually created, and working with the universities to say, listen, we've been doing this for 7 years now. We've identified that follow-on funding, especially to international investors, is a challenge because of the cap table that's just not aligned for an investor friendly.
So would you say that South African universities then are starting to come around and to understand that an overreaching equity claim can just kill a spin out before it even starts?
I think they have come a long way, absolutely. And those universities that are more prolific with regards to spinouts and are in hubs where you have international investors and VCs get more of that understanding, and they are certainly coming to the party now. I think that's one of the concerning things, and generally the sad things which we have found. We engage with all universities very much actively. We visit them, we speak to them, we try and understand their challenges and what deal flow they have. But those universities that are outside key hubs, innovation hubs, where they don't have exposure to corporates, to risk capital, don't get that perspective, and they're slower to the party when it comes to creating the right structures.
Now, when one looks at one of the big issues, whenever I chat to VCs outside of this particular ecosystem, but it is often one of where one locates the IP in order to raise international funding as well. And exchange controls, I'm going to put my personal views to one side for a second because I just think they're anachronistic in a modern open economy such as our own. But how are you getting around some of the exchange control challenges around IP and maybe getting international investors or international funding to come and back some of this world-class research that we are producing?
To be honest, it's a massive challenge, and it's something that we deal with every day, especially when it comes to later rounds, Series A, Series B rounds, where we need much deeper pockets to be able to expand internationally. The international investors are coming back and saying, listen, with the exchange control, with the challenges and the potential risk, we want the IP out of South Africa. And that's sometimes not possible. In some instances, we're going the long route, and we're currently doing that now. We have a US VC that's co-investing. They're leading, and there's a couple of South Africa's VCs that are investing alongside us. The requirement there is to actually go through the whole SARB process to externalize the IP, which is obviously costly, and that money could go to growth. And so that's one example. Others are, the valuations are just decompressed completely because the IP sits here, and we've had to accept that as well. Where
Yeah.
had the IP been in another jurisdiction, we would get much higher valuations. And then in some instances, we're creating mirror structures where we start working on new pieces of IP offshore, and so generate value in different jurisdictions. But again, that's a much longer play, and you need investors who understand that and are patient. And that's, again, a major issue. Capital chases quicker wins.
Yeah, absolutely. I know we're talking about a broader overhaul of our capital flow rules to attract more investment. Obviously, we want to position ourselves as a financial hub. Are those reforms likely to make a practical difference for venture backed tech companies, or is the devil still in the implementation for you?
No, I think it will make an absolute difference. I definitely think so. Even simple things with visas. I mean, I can go back to my days as being part of the Smile Identity team. We started scaling in Africa, and I would wanted to build, being a South African, I wanted to build a hub here. We still have a Smile ID, many fantastic resources in South Africa, but we couldn't bring people from Nigeria and Kenya and relocate them here. It was just too complex. And so what that meant is we had to create teams in Uganda, in Kenya, in Nigeria, and that's costly. And you don't get the type of cohesion often that you require. So even a simple thing like visas would go a long way. So I think it just adds risk, and we're working, especially in the asset class we're working in. It's very new. It's relatively unproven. We're the first in Africa to actually focus on this asset class. And there's a general lack of liquidity. And if you look at what we're investing in, it's generally deep tech. And again, that takes long to develop and there's less capital. So any little additional risk that you add to it just decreases the likelihood of success of that company and raising capital.
Absolutely. It's one thing that was said to me a long time ago by Mr. Michael Katz at Edward Nathan. It's like in golf. Often, the longer the distance, the more risk that you introduce into any deal or shot as well. Now, talk to me about the LP base and what it says about what you can achieve here, because it's interesting. You've got the SASME Fund, you've got Universities Philanthropy, Sunlum, Fireball Capital, and the Technology Innovation Agency. What does that mix tell us about the kind of capital required for university commercialization? Is it important to have maybe different return expectations among those LPs in order to make this work?
So in our first fund, it was the SSME fund and TIA and CEDFA that really backed us because, again, it was the first of its kind. And those are really patient investors understanding the complexity in this asset class with relatively modest return expectations. Our portfolio in Fund 1 is doing incredibly well. And so when we started looking to raise for Fund 2, at least we had the ability to point towards the portfolio and some success stories, which helped us to be able to go to the actual universities. And I think that was key. We went to the universities themselves, especially the universities that have more capital that are in hubs, so venture and innovation hubs. And we went to them and said, listen, if we are to be successful, and we have to be to continue this, we need your money in so we can go to corporates and other investors and say, listen, the universities believe in this stuff. They have a vested interest in this stuff. And so we were very fortunate. The first commitment we got was from Stellenbosch University, and it was a very large commitment. We then went to UCT, we got that, WITS and UP. We went to various other universities and they just didn't have the capital to be able to place it. But when we had those universities on board, we could go to the likes of the Sunlums and the Allen Greys and back to the SSME fund to say, listen, we've got the key component here and let's all move together. They've all pulled together. They understand the importance of this asset class for South Africa and for maintaining the brain drain, for reducing that brain drain, should I say, and continue to build innovation with universities. And so their return expectations are aligned to other proven asset classes of slightly lower risk.
Imagine if we could have kept Michael Thackeray in South Africa, the father of the lithium-ion battery, which underpins most of modern mobile technology today, what we could have
100%.
achieved. I mean, we really do produce innovation, and let's not even go down the Elon Musk path, but innovation that competes at a global scale. And it is always about, can we then marry that with the capital to keep it here, grow it here, scale it, and just think about what impact that could have potentially on the fiscus as well, if we can ever get past exchange controls. I don't want to get bogged down in that, though. Talk to me about, and you mentioned it earlier, I mean, the professor is not always a CEO. And with all due respect, you can be a great academic, but it's a very different skill set to then taking an innovation and building a business around that. How do you decide whether the academic founder should run the company, advise the company, or step back? Those must be quite tricky conversations.
They are tricky conversations. And I think That's one of the privileges we have, Danielle and myself, is we are entrepreneurs. We have been founders. And so I think we've got a lot more empathy than a lot of other VCs that potentially don't have that experience. They haven't sat across the table, tried to raise money, tried to build teams, and sometimes failed. And so I think that empathy, we've utilized that over the last 7 years, and we work very closely with universities to build that trust, because universities at the end of the day, they're the ones where the professors are coming to them and saying, this is what I'm working on, can you help me raise funding for this? And often universities have walked 5-10 years with these professors, and so they bring us into those conversations relatively early. We've got a great success story where we started working with these three young founders 2 years before they even started to raise money, and we've now backed them on about 4 different rounds. They are actually a profitable biotech, which is unbelievable. So I think it goes to building that trust, and it goes to, these professors often have never been wrong at anything. They've always kind of excelled because they are so specialized. And so when someone just comes off and says, listen, and challenges them without the trust being built, it doesn't go anywhere. So very much close alignment with universities, building trust, and then being very milestone driven initially in our investments, where we actually challenge the team and say, listen, we'll put a little bit of money in, but we want to see the following steps. And it's not just technical steps, it's build the business model a bit better, go and speak to more customers. And that we often do at seed level. So we really are testing the teams and building them while we're building the plane, really.
I was going to ask how you assess that founder market fit in a university spin out where you may have great technical insight, that could be world class, but the commercial problem is probably still being discovered. So I would imagine that's all part of your process as well. Would you say South African academics are becoming more open to entrepreneurship, or does the academic promotion system still reward publications far more than patents and being able to produce a product or a company?
I think you hit the nail on the head. I think it is, you can see that in the different universities. When the incentives are not aligned with commercialization in some way or form, then you do not see that coming through as prolific as other universities. So incentives, of course, that's something that one needs to align. But again, you need to be careful how you incentivize these things. If you don't incentivize publications as well, then you're not going to get the research which is kind of truly groundbreaking. People need to push the boundaries, and often we don't know if there's a commercial opportunity out there. So I think there's that balance that one needs to create. I think the other thing is, you've got a lot more young researchers that are working with professors, and they are just entrepreneurs. The younger generation, they understand that they're not going to walk into a corporate, and don't want to often walk into a corporate environment. So they see themselves as entrepreneurs, and they push the professors to think in that manner.
Oh, that's fantastic to hear, because there are so many problems with opportunities to develop businesses around. If you just look at the context in which many of our academics are operating in South Africa. With that said, which sectors would you say are most promising for South African university-linked companies to scale globally? And I know through your portfolio, you've got Cube Space, which is, satellite systems. You mentioned biotech in Amobazine. You've got so many
Yep.
insights there. Where do we have maybe niches where we have a comparative advantage in South Africa?
Yeah, we do have some niches, and I think we've also got to, if you just look at our population and a lot of the big corporates which we have scaled across the continent, and that's, the corporates are a big piece of this. You can't create a successful innovation ecosystem without the corporates, and I think that's something which we've lacked. Entrepreneurs haven't worked as well with corporates as they can. So if you look at that from the mining side, we've got a lot of interesting engineering solutions that are being looked at the moment. The medical industry, South Africa has always been prolific and on the front end of innovation in that sense. So medical devices and the life sciences, we see amazing opportunities there. Biotech is incredible. If you just look at some of the initiatives at some of the universities. So Stellenbosch has just started Siri Bio, which has a lab space where people can come and explore. There's another VC, One Bio, that's also created, again, a biolab space where young founders and entrepreneurs in the biotech industry can come in and utilize their lab space and get mentoring as well. So I think those are some of the key sectors that we're looking at and we see. And there's more investors now starting to come to the party, and opening up those sectors within their mandate as well.
When you go and raise capital from your LPs, How have you asked them to judge a fund like this? Because given that deep tech commercialization often takes longer than a conventional software startup, for example, do you have a longer mandate? And what does success look like for UTF2? Multiple on invested capital, a few international exits, jobs. How are you asking LPs to judge you?
So that's a fine balance, and I think it talks to all of those. We are absolutely a commercial focused fund. We have to be, and that's what we tell. There's a lot of opportunities we'd love to invest in, but we just don't see that those are VC backable entities. So we are absolutely a commercially focused fund. We have return hurdles which are somewhat aligned to other VCs, some actually slightly lower, because I think we've got investors who understand that this is a younger asset class, but super important. So we have been fortunate in that sense. And I think what you mentioned there is very important. The time expectations. The traditional fund of 10 years plus one is how our funds are structured. However, the verdict is still out in Africa, and especially in deep tech, as to if that's long enough and if those structures are correct. But nonetheless, that's what we
Yeah.
have in front of us, and we believe we will be successful in that. And of course, absolutely, if you look at what universities are doing, universities are geared to solving problems in society, or challenges or opportunities in society for the better of mankind and for the better of our economy. And so we are absolutely judged on the amount of jobs we are creating and the amount of successful spin-outs that can actually start generating profit and be sustainable. And I
Mm.
think to that point, because we are a commercially focused fund, we are absolutely going to have some international exits, because that is the one thing that VCs often struggle to talk about. Is let's talk about exits.
Yeah. Yeah.
It is very nascent. The VC industry in South Africa is very nascent. A lot of the family offices have had them going for a long period of time, but true funds are very early, and that's something we really need to start working on, and that needs to
Yeah.
be international.
Yeah, I mean, I joke that how do you spot someone who works in private equity when they're at the dinner party? They're the first one when they enter the door that they're looking for the exits already. But I think more so with VC, and you chat to Kit Van Sale at Knife Capital, they've had some really high-profile,
Yes,
successful exits. It's possible. We can do it. Let me put the skeptical case to you,
100%.
though, Wayne. We're a small, low-growth economy with relatively weak public institutions. We've got limited following capital. We've got slow corporate procurement. Why should university linked ventures work here?
Well, I think it's just the tenacity, and we've got as South Africans as well. And we've got so much history with regards to our academia. We've got strong corporates. Yes, our economy is not growing where it should be, but we've got strong corporates, and I think if corporates come to the party as well, I think they can partner with a lot of these startups, and they've got the distribution channels. And I think that's one of the things which we struggle with. Any startup needs a distribution channel, it needs a network, and corporates have that in spades. So, and I think people are coming around. There's also a lot more government initiatives. I mean, I've traveled around quite a lot, and with my MIT fellowship, we analyzed a lot of ecosystems. South Africa has a lot of this early stage funding. I mean, if you look at the Department of Science and Innovation, they have several arms of funding, like TIA, for instance, who are now playing a fund of fund game where they're backing fund managers to deploy in certain sectors they believe are important. So I think you have that. And then again, you mentioned a few successful South Africans abroad. We've got a lot of South Africans abroad that have made a success abroad or locally, and that have decided to either move back or permanently relocate themselves in South Africa. And they're starting to give back. And I think that's an important part. Growing ventures is very difficult. You need mentors. You need people to be able to pull together and work with you. And so we've got a lot of that, especially in our more developed hubs like Johannesburg, Pretoria, Stellenbosch, and Cape Town.
Yeah, well, you certainly done enough to persuade even the skeptical journalist in me, Wayne. I absolutely think we could be hitting it out the park. Again, with a little bit more policy support as well. And I don't want to belabor exchange controls, but we've also had tax incentives. Do you think, just lastly, we should revisit tax incentives for VC? I mean, we had the Section 12J. I know there were a few who really exploited the spirit of the legislation, or was that structure too flawed to
Mm.
revive? Is it a conversation? I mean, if you had the ear of the Minister of Finance, that you'd like to see some more incentivized funding going into this space?
Completely. You absolutely need more incentivized funding. And that's something, again, if a lot of the other African states are looking at as well, of highly incentivizing corporates and individuals for that matter. And I think you're 100% right. There were certain players in the market that maybe didn't do that justice. But I think if with better monitoring and better deployment of those incentives, it would go a long way for us to get capital in. The other thing is there's a lot of that government can do to align incentives. And I think that universities need to have some form of autonomy of how their policies are and their spin out should be. But I think a lot of the structuring stuff that we were talking about earlier, the government came forward and said, listen, if we standardize this and we make it highly attractive for investors and for those operating founders, if you all agree to that, we're going to give you X amount of million rand per year to act as a seed fund to help seed these opportunities. And if you don't do that, then we're not going to give you that money. I think that would go a long way to pushing the universities to structure the things differently and to look at it differently. And a little bit of seed capital could go a long way. Some of the bigger universities have a small pool, which they use then to seed some of these really early things before any venture really comes in, almost like an angel for that matter.
Yeah.
If we could have more of that, it would go a whole long way. And remember, even 500,000 Rand into some of these early stage things is a lot of money, because when the time this thing spins out, most of the resources are still sitting in the university. They're using the lab space of the university and a lot of the materials. So it goes a long way.
Wayne, I think that's a fascinating place to leave it. Thank you so much for your time in sharing a little bit more about what you're doing with the UTF Fund 2 at 400 million Rand, taking the Stocks Strauss University Link platform past the 700 million Rand mark. And it's certainly a test of whether South Africa can build a repeatable pathway from research and founder talent into something that is internationally scalable as an enterprise. My thanks to Wayne Stocks, Managing Partner at Stocks Strauss, for joining us here on the Monocle Banking Podcast.